Of all the trillion-dollar asset managers, there's nothing like Brookfield. We're talking about brooking the bucks, if you know what I mean. It's also by far the most expensive out of any alt. People are asking, how do I hedge against this position? Well, there's no financial advice, so figure that out. But listen. Brookfield touts 127-year history because they bought a Brazilian utility company or merged in. These guys are phonies. We're talking about phonies? Okay. They have a reputation. They are not on the same level as Blackstone, KKR, Apollo, Ares, all of Carlyle, all of whom I have an issue with. But I understand somebody saying, I'll take the other side of that bet. Who is buying Brookfield? Bill Ackman? Dan Loeb? Capital World? I don't get it. Let's go through it because I don't think any of their analysts are doing the work. And believe me, the work is hard. This took me 4 weeks. And I kept on going back to it and being like, finding more, trying to pull more of the spider web apart into like a straight line. It takes a certain amount of brain damage to want to do that. And man, do I apparently have brain damage. So Brookfield Corporation has the balance sheet. BAM, they broke out and they are trying to get it into the index. They converted some of the voting shares so that potentially the S&P would take it. S&P said, Dikembe Mutombo, no, because it's just a dance. And thank God, credit to them for that. BWS, their insurance arm, has grown from 0 to 157 billion in 4 years. Okay. Of all the fast growth in this space, like the whole private credit industry, largely catalyzed by this captive insurance game, has grown extremely fast. But Brookfield's by far the fastest. The Financial Times has reported this structure as a circular flow of cash. Very, very funny. Bruce Flatt is the CEO since 2002. He owns a large amount of shares. The board, it's got even Cockwell, who was the EdPer guy. So just so you guys understand, Brookfield's kind of born out of EdPer. EdPer was the quintessential bubble of the 90s in commercial real estate in Canada when they had a huge bubble. All went down, didn't go under. They managed to keep it alive. Brookfield was born. They have an Altman Z-score of 0.45. I don't mean to say that they're going to go bankrupt, but man, a huge haircut is possible. And they don't have as much margin of error as people think. It seems like every single time Brookfield gets in trouble, they just like move money around and it's all fine. As we know, these creative accounting games, they run their course eventually. And Brookfield's had a long, successful finagling of the financial markets and investors. And I think it's about up, especially with the catalysts that are coming / already here. $1 trillion under management, 257 billion in consolidated debt. They have this crazy structure. They have Brookfield owns BAM, and then they have BWS, and the BWS fees go to BAM. It's this crazy organizational chart. Their distributed earnings, 6.3 billion, but their GAAP net income, their GAAP earnings, 641 million. What's the discrepancy there? We'll get into it. The structure, crazy. These guys are all made by accountants. So I won't go through it all. If you want to, you can go to Substack. I really want to talk about the flywheel, which I've talked about over and over again. These guys, these private equity guys are buying insurance. Why? Why do you buy insurance? Why do you buy RAAs? Because you buy assets. And very quickly, you immediately become the asset manager. And very quickly, you get your payback because you get the management fees. And it's even worse. Dan McCrum and Antoine Gara of Financial Times. If you don't know who Dan McCrum is, he's kind of the GOAT. As far as, journalists under the age of 40, I mean, he might be 40-ish. Dan McCrum took down Wirecard, kind of the GOAT. And he's called this a circular flow of cash. That perfectly describes Brookfield. He documented 4.1 billion in Brookfield Property Partners real estate assets sold to BWS at existing valuations. The marks. Oh my God, the marks. We'll get back to BPP. In 2024 alone, Brookfield purchased 7.8 billion in related party investments from Brookfield entities. There's been plenty of people poking around in this. Hopefully, I can cut through the noise. That's what ideally I want to do. Again, Brookfield growing from 0 to 157 billion is faster than Athene, faster than Global Atlantic, which is owned by KKR, Everlake, everything. They bought Anico first, and they cede all of it to an affiliated reinsurer domiciled in Bermuda, where you can't see it. Huge issue. Guys, let's just pause for a second and understand that we have state regulators on these insurance companies, and then we have these affiliate paper that we just send to the Bermudas to another entity that we can't see. We can only see what's in the US, all the capital that's backstopping it, we can't see. We can only see 8-page consolidated statements. Crazy that we're just trusting that. Of all the things, that we know about human nature, we're like, and obviously the mechanism for fraud to exist, we're like, that's fine. Let's just do that. It's cool. Then they strip, these insurance companies of assets, the capital surplus, which if you don't understand, these guys talk about leverage in a way that doesn't make sense, because annuity in life, their risk is to the balance sheet. So I want to know how much equity, capital surplus, do they have for their assets? Because assets and liabilities are very high. And by that metric, they're extremely levered. They strip that capital surplus because they want to optimize returns. They don't want to have cash sitting around. They want to pull it out and put it somewhere else or show it to their auditors as the holding company's cash balance. It went from 4 billion to 2.26 billion in 3 years. The surplus that took 117 years to build. And I'm kind of using their numbers just because it's funny. If they're marketing 117 years of history, fine, that's it. Oh no, actually, Anico actually is 117 years old. And then they plug the holes. So consistently, what you see with Brookfield is like there's a problem, and they just like, okay, take money from this pile, put it there. Accountants, man, that's what happens when you have a $1 trillion asset manager created by accountants. AEL, if you read the letter or the whole, you should read the letter to Johnson and the whole if you're interested in this. Both of them on Substack, on Twitter. AEL, they purchased, and by accident they released in one of their tech team. They just didn't know. They're like, release the stuff, put the marketing docs out on AEL purchase, and they put the statements. And on the statements, we saw so much blank space. Tom Grober did this work. He caught it, and maybe a reporter got it from him, but he really broke it down and went to Hanover for this one asset. It's called an excessive loss asset, XOL. And that basically says if your assets go down below a certain level, Hanover's going to pay. Thing is, you go to Hanover and they have no reserve, meaning they don't expect to pay. And what that means, my opinion, is that the strike is too low. It's clear that they don't expect to pay, but I'm just like, the put is at -$5. And what that means is when it hits a certain level, that's what the RBC ratio is meant to capture. There's the company action level, and then there's the go straight to jail level, which is receivership. And that margin of error is completely negative. If it wasn't for that XOL asset that they invent, we saw 1.48 billion. Hanover's entire capital reserve is 775 million. And then I guess we're trusting the Bermudas again to have it. No, I don't trust. You got to show me the money. Without that XOL asset that Hanover says they're never going to pay. AEL1 is negative in equity by a lot. Then they covered it up and they said, oh no, big mistake. There's 3 AELs. I imagine they're doing the same thing to all of them. I imagine all the private equity guys are doing this, but Brookfield is dumb enough to show us. 5.28 billion is total between those three assets. They're just stripping out, these companies. It's in Vermont. Vermont says that you don't have to show a capital insurer, so that's why they didn't have to and weren't supposed to, according to How to Get Away with Fraud. And then, this whole thing, without the captive, they fail the test. This is the biggest problem. The fact that we can't see it. If we could see it, we could look under the hood. 100% the gig is up. There's not enough money to move around to plug these holes. The marks, the DE to gap. So distributable earnings is DE. Gap is net income, your price to earnings ratio. They want to show, as accountants do, the creative numbers that they want to show that is designed to strip out impairments. I kind of care about impairments, don't you? Brookfield doesn't. Their multiple of DE to gap is 9.8 times. To be fair, the 3-year average is 3.1 times, still 4 times higher than the peer median. The other asset managers don't have this huge gap, between impairments and, or markups and what the gap earnings are. It excludes unrealized losses, mark-to-market adjustments on the real estate portfolio, of which go do the news on how bad, their real estate portfolio is. They picked up the pedigree from Ed Purr brilliantly on that. So many conflicting valuations to go through. Here are just some of my favorite. There's been a lot of great work on. They had a pipeline with Kinder Morgan, and Kinder Morgan's taking a massive impairment. 430 million, writing it down, and Brookfield's writing it up through BIP, Brookfield Infrastructure Partners. They did it the same thing. This one's actually even crazier because there's a toll road, and it's publicly traded Brazilian toll road operator. Part of it is owned by a Spanish infrastructure company called Albertas. And part of it is trading, like free floating. So if you have a stock, like some accountant, please explain this to me. If the stock is trading at $8, how, when the quarter ends, do you have it at $20? They had it about 3 times higher on their books. Even Albertas had it higher too. Even Albertas had it lower. So they're higher than Albertas and the publicly traded stock price. Then they decide to buy it out, as they do. You're going to see this a lot more. So they decide to buy it out. And there's there's so many stories like this. They decide to buy it out and they pay a premium to it. It's trading at like $8 or whatever. And all of a sudden they buy it out for $10. So what was it before? 7 pay 10, pay premium, pretty typical. Then all of a sudden they mark it up to like immediately 14. And the match between, because it's a weighted average, the match between the $20 they had in their books and the 14, it like perfectly averaged out so they didn't have to take an impairment or a gain. Like legitimately reverse engineered, as you hear some private equity guys do on IRR. That's insane. That's insane. Someone go back and see that. There's so many things. You just have to look at one of these things and you have to be like, I trust none of this book anymore. Brookfield Property Partners. Oh man. During COVID, this thing collapsed. It's doing horribly, worse than Vornado, worse than everything. Defaults started going crazy as defaults are going crazy now. The assets that did not default were rotated in insurance subsidiaries. This is, they're having the insurance subsidiary that is supposed to be backing up policyholders buy these assets way above what the market is saying it is. They took it private at $18. It was trading down to like $8 at one point. And an independent validator valued it at $14 to $18, and you pay those a lot, so same incentives at play. I wouldn't trust those. Independent. Yeah, well, you're not independent from your paycheck, and who's paying you? Brookfield. Um, so yeah, huge discount, put it on the books of the insurers, $4.1 billion. Another example of this related party scheme. And again, guys, BAM trades at 24 times forward earnings. The peer average is 12.9. Go out to the alts, okay? Just tell me, like, I am bearish all these guys, okay? But if you're not bearish all these guys and you're going to find a stock to buy out of the group, why would you buy BAM? It don't make no sense. It don't make no sense. Do you think that Blackstone, I think all these guys are allocating too much capital for it to be intelligent. I think the good private equity firms, the good private credit firms, they have way less capital. Because otherwise it's just a deployment game. But still, talent at Blackstone, KKR, Apollo, Ares, Carlyle, or Brookfield. And yet it's trading at a massive premium. I think it deserves a discount. If you look at conglomerates and the public markets, they trade at discounts because they're not pure plays. They kind of own a lot. It's hard to look through. It takes time. Investors don't like it. For some reason in finance, the more complex, it's like a defense mechanism, and investors still pay. I think that is changing and soon to change hard. Catalyst, office debt wall. I can't even tell you how many times Brookfield's going to walk away or has walked away from a property. You see some commercial real estate going for basically pennies on the dollar. It's pretty insane. Balance sheet, this insurance game, they literally messed up so bad with that AEL. What you're seeing is the coverage, the media coverage. I am talking about it. Everyone listens to me, and they're just like first of all, the rest of private equity guys are going to throw them under the bus for what they're probably all doing. Be like, Brookfield, you got to take the charge here. You got to take the charge here. It's not our fault. It's not our fault your tech team did that. So that's happening. Private credit, scrutiny, insurance scrutiny, changes to disclosure and risk assessments. Like, people talk about, this RBC ratio and how it's similar to tier one, the bank reserve ratio that has been instituted since Dodd-Frank and what's the Europe? Gosh, damn it. You're going to make me do this. I'm tired. Bank ratio rules. Capital adequacy ratio, tier one leverage. Basel. Oof. Basel instituted that. The way that Basel underwrites risk because of Basel, the one that tier one leverage ratios work is way, like, it actually adequately assesses risk. What happens on the RBC ratios is insane. There's a lot of stuff that is, completely excluded from it. So I think it's a whole industry issue, and I also think it's a massive systemic risk. Like, I'll continue to talk about that. This is a $10 trillion balance sheet. Brookfield is the prime perpetrator. Maybe they're not the worst, but they're, they messed up and showed us. So there's that. And I think that they're going to continue to take heat for that, again, from a premium position that's been relatively unspanked. Legal and regulatory overhang. There's been whistleblowers against this, alleging fraud, bribery, whistleblower retaliation, and 100 million inflated AUM on some specific thing. Listen, Brookfield's known to play nasty with $1,500 an hour lawyers that will pester journalists that are working on a story in order to explain to them what the reality of the situation is. That's kind of typical in the PE space, but I don't think it works. I don't think it works long term. I think it just kind of emboldens this ridiculous thing. You got to understand, there's risks to the short, blah, 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 boring. You got to understand that, one, the bull case is that the NAV is super undervalued. You know, if you're Howard Marks, Howard Marks is now bought out by Brookfield, you know, at 79 years old. Howard Marks, you need a margin of safety. So you think, okay, well, if it's 40% discount to what the managers say NAV is, I think it's 20%. That gives me a 20% margin of safety. I can buy that. When you actually consider their marks, I don't think there's any discount. And I think you're trading at a huge fee premium, and that fee premium could go down. And I think that there should be fines based on what they're doing. And AEL, and it's also Canadian. Like, why are we allowing Canadians to do this to our markets? I don't know. I don't like it. In my view, this is the best alt short available. I'm short complexity, especially in finance. If it's not simple, if you cannot explain, if you're doing this magic dance and moving capital piles in order to, you know, fulfill what, you know, would be reasonable, you know, when investors look at a part of your business, sorry, I'm looking at all of your business. And I think a lot of people are going to start to. Conglomerates deserve discounts, not premium. So BAM, you could also do BN through the, to short the actual balance sheet, but BAM is like super pricey. Again, these guys think it's permanent capital forever. It's rainbows and orgasms forever. So therefore you want to pay like super premium, you know, SaaS, formerly SaaS multiples for this kind of stuff. I don't think so. For long short managers, pick something else. Pick something to long. Like, what are we doing here? You know, short BAM, short BN, depending on how you want to trade it. The only way that they get out of this, in my opinion, or the only way, listen, no financial advice. I think you could size up in the BN side. The BAM side, I'm a little concerned about the fact that they consistently, like, if something's going wrong, you know, it's not going to happen from now, but like, let's say it goes down 20%. If something goes wrong, they can just like take it private. Now, granted, that would take a lot of money considering BAM is 82 billion in market cap. But it's a risk. There are some risks, because if you want to read this whole piece, it's on Mispriced Assets. Sweet.